Hello, dear listeners, and welcome to another edition of Ahead of the Curve, Acadia's podcast. With me today, I have Stuart Smith. He is co-head of business development here at Acadia. My colleague, welcome, Stuart. This is our third podcast together.
Yeah,
and it's the third different studio we've been in.
I like this one though.
I love this is my favorite one of all three, so
Yeah.
I'm very happy about that. We're going to be talking about counterparty credit risk today. I know it's near and dear to your heart. It's near and dear to Acadia's heart. And just to set the scene, there was a consultation paper from BCBS that came out in April, right? And it really is just a set of guidelines for how to manage counterparty credit risk, and it has quite a few different parts to it. I think that's what we're going to focus on today. We're going to not pull the entire paper apart, but we're going to talk about the things that I think are important to us as a business, important to our clients as well. But it's a very interesting paper, and I think it's one of these spaces where it's a wait and see where it goes. But I think in the interim, what we can do is digest it and ensure that we understand from a business perspective what it's going to mean for our clients potentially, and how we can help. So why don't we just dive in? I'll ask you the question of why this paper, what does it mean? What's its purpose? And then we can take it from there. So, What is it? What are we talking about?
So I think, risks have exploded across banks. And if you go to risk conferences, there used to be a credit stream, a market risk stream, a liquidity stream. Now there's dozens of streams. Cyber risk is seen as, biggest risk and other things. And in some ways, counterparty credit risk has been somewhat lost in the background. But in the last few years, we've seen many events, traditional counterparty credit risk defaults, like Archegos, which then triggered the default of a household name in Credit Suisse, and other defaults as well, which have really brought this back into the firm view of firms and regulators. Realistically, after 2008, an Archegos default, it should be able to happen. There's always going to be defaults, but it shouldn't have had the consequences and knock-ons that it had. Mm-hmm. We thought we'd done enough post-2008 that you couldn't have events like a bank like Credit Suisse being taken down by that kind of event. So this, as you can imagine, caused regulators to really go away and rethink and relook at what they're doing and say, okay, have we got everything right? Are the capital rules right? Is the guidance right? So this is not about capital. We talked about that a while ago, around Basel III and the end game that's going on in the US. This is on the governance side. So this is more of a set of directives to the bank they need to interpret, understand, and then implement within their structures, applicable to them, and the regulator can check that they're doing it. This is still a consultation, so nothing's final yet, and There's a period for comment open till the end of the summer. But this is really about setting up your bank and understanding your responsibilities to act in a way that the regulator sees as fit and proper. Mm-hmm. And hopefully this time really mean we can't have another Archegos that brings down another big bank.
Yeah. Well, it makes sense. Anytime an event like Archegos happens, it's always going to trigger the regulators to rethink, like you said. Mm. And I think that's what this paper is intended to do, right? But we already have established procedures and counterparty credit risk mitigants that already exist in the market, like initial margin. Let's dive into that and what the potential changes are, or what the recommendations might be to either, I'll say enhance, not change really. It's because we do have a foundation, right? So it's not, I won't, like, what we have to make sure is, when we're talking to people and listening to this podcast, is that the consultation paper is clearly not looking to re-engineer what already exists. It's really, to me, it's pointing things out that potentially have weaknesses and to enhance them, maybe potentially make them better.
Yeah.
So let's talk a little bit about that in terms of paper recognizing initial margin, and then the difference between static IM versus a risk-based approach.
Yeah, so worth noting that Archegos wasn't part of the Reg IM. They weren't large enough to be posting ISDA SIM. Right. And therefore they were probably on a House IA background and posting probably a static amount against the trading that they were doing. And that's really called out as being maybe something that's not fit for purpose anymore, and something that banks should look at, in that either if they're going to use a static measure, that measure may well need to be quite a lot higher, or they should be moving to a risk-based measure, which can better capture some of the risks around complex transactions. They also highlight that, the cases where you're going to see these really spectacular defaults is probably going to be quite linked to posting margin in the future. It's kind of a class of default that maybe we didn't really think about in the past, where the trigger for defaulting are very large margin calls, and those margin calls kind of been a self-fulfilling loop. And in that case, margin becomes very important. But having a static measure, I think, really called out as being something that's not the way to go anymore. And if you think about the traditional pushback against that, it was always, oh, well, we can't do that. It's too complicated. People couldn't understand it. People couldn't handle it. They couldn't replicate it. All of those questions have been...
Yeah, there's a standard risk-based model that's out there. Been used for quite a few years. It's called SIM, right?
Yeah, and I think SIM has said a lot to the industry about what's possible and what buy sides are capable of doing. And a lot of those kind of excuses, if you want to call them that were used in the past, no longer seem relevant and no longer credible to say, oh, the buy side could never cope with something like this. It turns out they can, and they can do it quite effectively.
Yeah, I mean, do we think we're I mean, from an Acadia perspective, it's something that we look at in terms of using the SIM for what we call house IA or independent amount from a non-reg perspective. Can we talk a little bit about that in terms of, the appetite for that, and maybe this paper will kind of, help firms who are either skeptical or, like you said, don't think they're able to do something like that, look at that as an opportunity or, a possibility to do something different, and potentially it could satisfy, what the guidelines are being proposed now from this Basel paper.
Yeah, so definitely. So I think where firms want to take on a risk-based IA, they've all got a similar challenge, which is, can I get my counterparty to agree to this?
Yeah.
Can my counterparty still, challenge it potentially? Can they understand it, and can they understand an incremental cost against it of doing new trading? I don't want to put them off doing new trading with me because it's too complicated. And I think, a lot of firms have stepped in. Acadia, definitely one of them, has shown that, yes, absolutely, we can provide a bridge for you to help those firms understand the calculations, whether they be as the SIM or whether they be something else as well. There's variance. There's also just different metrics and measures. Help people understand them, help people understand potentially incremental costs and optimization opportunities, and then facilitate them going live with that and using it operationally as well. So I think, I don't think we know right now. I think there's a period of time that's going to go by when people decide how they're going to go with this. Maybe they say it's easier just to increase my IA and be in more control of it. But if they do go down the risk space, I think it'd be a really interesting space for vendors again to get involved and support the buy side in understanding this and using it day to day. So yeah, exciting times. It's sort of interesting to see how it plays out over the summer, see what some of the commentary is back from the organizations.
Yeah, I think the comment period runs through August 28th. The time of this recording, I think we're at the end of June here. So yeah, it will be interesting. I think we'll touch on a little bit later on what we think we'll expect out of this, because we are, we do have a connect. We are kind of connected to the regulatory community in a nice way. So it'll be interesting to see. All right, shifting gears a little bit to another topic within the paper. And again, we're really focusing in on the paper today, is scrutiny on wrong way risk. Now, wrong way risk could mean a few different things. And I know from my UMR days, it was specifically spelled out from a collateral posting perspective, meaning, and I'll ask you in a second what it means in this context, but from a collateral perspective, specific wrong way risk is, if I'm Bank A and I'm posting Bank A shares to my counterparty, that's specific wrong way risk for obvious reasons. If I go down, so does my collateral that I post to you. So it was always an obvious thing, and it makes complete sense, but it was called out in the uncleared margin rules globally, and was implemented. In this paper, in this guidance paper, they spend a lot of time on wrong way risk.
Yeah.
It's different than what I just explained. So can you just explain what it means in this context? Yeah.
So you've given a couple of examples of specific wrong way risk, where there's an intrinsic link, posting your own shares in equity as, collateral against a margin requirement. as soon as you start thinking through the consequences of that, in the case of default, actually those shares are going to be worthless. Right. So this is a very specific case of something that doesn't work. And you can come out with lots of different examples of specific wrong-way risk. They're normally quite rule-driven, and they're just things you shouldn't do. But it sounds easy. Legal structures are complex, organization and hierarchies are complex, and it can happen. So this is something banks, I think, are actually quite good at in applying those rules and detecting them. What's much harder is general wrong-way risk, where there isn't a direct link, but there's an inferred link between the two. So the normal examples, if you go to a textbook and read about this, they'll talk about airlines. So if you look at an airline, its chance of surviving and still being in business is intrinsically linked to the price of jet fuel. As jet fuel price goes up, the chance of your airline making it into next year goes down. Makes sense. You're selling kind of fixed price tickets against a variable cost. So a sensible airline might say, okay, there's too much risk there for me. I'm going to enter into a transaction with a bank to hedge out some of my risk on jet fuel. So I might sign a total return swap, say, with a bank where I'm going to pay a fixed amount monthly, and I'm going to receive an amount linked to the price of jet fuel. And then I can sit on a fix, and the bank is taking the risk on the price of the jet fuel.
We do in the rate space all the time.
Exactly.
Yeah.
Perfect.
Yep.
So in the bank's case, you're going to get paid out when the price of fuel goes low, and that's the case where the airline is definitely going to survive. That's a fantastic case for the airline. All airlines are going to do great, and this is fine. In the case the price of jet fuel goes very high, okay, it's been bad for your bank. You've signed a bad transaction. That has to happen, right? Yeah. It goes both ways. But the airline is going to survive because you've hedged them out. Yeah. So this seems easy, right? So we'll just align all firms, understand what's going to cause them to default, and then we'll sort of make sure we're not aligned with that in risk. Of course, when you get into the reality of it, it's quite a lot harder than that. So maybe an airline does sign one of these TRSs with one bank on the street, and then they realize, actually, we've done too much. We haven't sold as many tickets as we thought we did. I need to unwind a bit of that hedge. So they place an opposite direction hedge with a different bank. And of course, the other bank, it looks like they're speculating on the price of fuel, and they're wrong way on that TRS. Yeah. So it's very hard to understand, are you, right way or wrong way against an organization, especially when you don't know everything that's in their book. Right. And that's the simple example. and then you go into the really murky is the wrong word maybe, but for a firm like Archegos, they're holding huge amounts of equity in the same things they're taking punts on, and this created a huge wrong way risk for them, which was, from the bank's perspective, very hard to detect unless they went and looked at their balance sheet regularly, understood exactly what was there and their other transactions. It's very hard to see that was the kind of risk that you were taking and that it was wrong way.
Why is it hard? Is it just because of conflict of interest or privacy, or just there isn't a mechanism? Because to me, this is all about it's transparency, but transparency is not like everybody wants transparency. But when you're talking about placing bets and investing, you don't want to show everything. But from a risk, from like what we're talking about here, so there's this balance, right? It's an interesting balance. It's a really interesting space. The more I kind of unpack it in my mind.
So I think there's two things that make it hard. So the first thing that makes it hard is the thing we were just talking about, just getting that information from your counterparties regularly. And this is really what your credit officer's there for. You should be talking with that counterparty, understanding their business, understanding their funding mechanisms, and continually making those judgments on where they are. And then also informing the quantitative team about the types of risks we're worried about.
Right. Which is done now. This is normal practice.
It's done, but that's a difficult job.
It is.
Especially when firms maybe don't want to release some of that data, and you're being a bit more forensic about what you're doing to try and understand it. Then the second half of it is what you do with that information. We talked through a kind of a very simple, straightforward example with a corporate. Those, actually, we can normally get those. It's the ones where you get out of that space into the more complex space. Then you're really reliant on models and PFE in general. So potential future exposure, thousands of scenarios. And then I have to somehow turn on a defaulting mechanism within that model. And what we've always seen is when you try and turn on that defaulting mechanism, forcing a counterparty into default in the scenarios you're looking at, the computation effort goes through the roof. So what we've seen, certainly through the 2000s, 2010s, a lot of firms implementing PFE, but very rarely implementing anything to do with a default conditioning in there. And that's really, means they're not measuring what they were always supposed to, which was the exposure at default. It was always what the regulation said, you should measure the exposure at default. And what they were actually doing was just measuring the exposure in a number of scenarios and saying if it defaulted. It's subtly different, but it's definitely different. But the reason they didn't do it is because they just didn't really know how.
Yeah.
It was such a difficult problem that I think everyone accepted it couldn't really be done computationally. The data wasn't that good at the first place. So, we may as well do the thing we can do. Right. But I think this paper is really saying, okay, call time on that. This area of wrong way risk is so important now. The margin kind of racking up of margin costs, that's made it even more important. And we really need to nail this area. Otherwise, we will see more spectacular defaults with really colossal losses. And we need to fix that before we go forward. So, there's going to be a lot of work done on PFE engines. There's going to be a lot of enhancements made. There's probably going to be a lot of new system implementations if, ultimately the scrutiny on that wrong way side really does increase. And a lot more requirement of data as well from firms to understand when it occurs.
You think, do we think firms are, I guess it depends on the size of the firm and how, how much tech they've invested and what they're doing now. Like you said, there is a structure, but it's hard and it's costly and it takes a lot of time. And I would assume, like, from an onboarding perspective and an onboarding governance perspective, this is kind of an extra layers that will add on. And I would assume that, maybe the tier ones might be able to do it a little bit more efficiently, maybe not. I'm just speculating. So what would be needed? Like, so if this consultation paper and what they're laying out in terms of wrong way risk and looking at it in the way we're explaining it comes to pass, where it's either a rule or it's something that everyone needs to do. Are we looking at new systems to be built, new solutions, new software? Where does Acadia fit into something like this? And can you kind of speculate on some of that?
Yeah, so I think a common place people have looked at, and I think a lot of banks have already done this, maybe particularly in the US, they go to a dual limit framework. So in the past, they used to have a counterparty credit risk limit that would say, I'm happy with this much exposure over 10 years, this much over 20 years, and maybe nothing beyond 30 years. Now they're likely to have that same limit plus another limit with a wrong way risk type calculation. And that's likely to be a larger number. And they have what they call a dual limit framework, where the exposure in the free case has to work, and in the what we call the default condition or the wrong way test works as well.
Is this, I want to stop you there.
Yeah.
Is this on the onset of taking on the book, or is this, I took on the book of business and going forward? Are we talking about more of an onboarding exercise?
Let's take a step back. So when a firm comes in to onboard and say, I want to start trading with you.
Right.
See, the first thing the bank's going to do is, okay, well, who are you? Show me you have some assets behind you to do this. And there's a process of onboarding.
Yeah, there's KYC, there's AML, exactly. There's all these things that already exist and are rules for that.
And as part of that, you're going to agree some kind of margining approach. Maybe it's going to be a very high house IA. Maybe you're going to do a Reg IM because you're already very large. And then from that, the credit department will work out what credit limit you should have. Right. Not dissimilar to your credit card balance, limit, on your personal credit card. This is the amount we're willing to take with you. The more collateral rules, the better collateral rules that you've got in place, probably the higher you let that go. The more secure the balance sheet, obviously, the more you're going to let that go up. Smaller firms, poorer collateral terms, you're going to see that limit really squeeze down.
Yeah.
But like we said, now looks a lot like it will be two limits. So one, just the day-to-day limit maybe that you can do, and two, maybe a periodically run, a weekly run of this kind of stressed but default conditioning stress to say, okay, right, when this counterparty is going to default, am I still under control of what's there? And if you'd done the same thing with Archegos, you would have found that wrong way risk number. That limit would have been orders of magnitude higher than their credit exposure. And they're really hoping that this mechanism will force banks to find that and to fix it. Or that they'll just weed out firms who aren't in a good position to trade at that onboarding step.
Yeah, there's a couple of different angles to this, right? It's not just, I'm going to do this wrong way risk exercise and determine the appropriate levels of margin, it's also, maybe I just don't do business with this type of, entity, counterparty. And so maybe that will force different behaviors too, that we can't, we won't speculate into this, but maybe that's another element as well. Sorry, I interrupted you for a second.
But you also asked about what that means for system change.
Yes.
So there are plenty of PFE systems out there which don't have a default conditioning mode.
Mm-hmm.
I think most systems are going to have to, implement something new here. There's a lot of new thinking coming out from regulators and other people around the right way of doing this. And we saw at Aquant Summit an interesting presentation around some mechanisms you might choose to bring that mechanism in. I think, there's still a lot of thinking to do here. Then there's going to be a lot of coding, and then there's going to be a lot of system upgrades.
Yeah.
So it's going to be an interesting time. And I think, always handling this area was right for the industry. I think it's going to be great to see it done. But I think we can expect to see quite a lot more computation load off the back of it as well.
Yeah.
There's going to be a lot of work to do.
Yeah. So, is this, from your position here at Acadia, is this like one of your main priorities and focus right now?
Yeah. Obviously I think we're focused on just
I know you focus on a lot of things, but
understanding the regulation and seeing how the consultation goes and seeing, what sticks ultimately next year.
Yeah.
But this is definitely an interesting area, and we're definitely engaged in the quantitative community around the kind of research and understanding what's possible and what the new standards might become off the back of this. So I think we're still very much in a thinking phase.
Yep.
But no, it's definitely an interesting area that we want to be at the forefront of.
Yeah, we know what we do best, but I do think that you're right. We'll see how this shakes out, and then based off of that, I'm sure Acadia will be well positioned to help in a lot of these areas for sure. Before we end, what do you think the timeline is? Are we looking at next year to see kind of the final paper? I would assume so. If the comment period runs until the end of August in 2024, usually they have to digest all of that depending on how many responses there are. And I know there's a lot of industry efforts underway to do that. And Acadia is always, when is appropriate for us, sometimes we'll join in on a response, or we do our own response, which we've done before. I think largely this seems positive, right? Generally speaking, from our perspective.
Yeah,
from our perspective.
You could read the document and maybe say that 90% of this is common sense. This is surely all banks should have been doing this. But
right.
It's good to write it down, though.
Yeah.
10% of it is definitely pushing beyond maybe what standard is today.
Yeah.
Definitely in particular geographies. So, I think it's definitely a positive step forward for the industry. More focus on, not allowing very large losses to happen like that. Makes sense. It makes the financial industry more stable.
It's all logic,
yeah.
Right? I think there's a lot of thought put into it as well.
Definitely.
And lessons learned.
The timeline, it's going to depend what the feedback is, of course, right? That's the point of having consultation. But thankfully isn't going to be it's not like passing a capital rule where things have to pass into law and ultimately, affect directly. This will happen much quicker than that if it does go forward.
Yeah.
Individual regulators can choose to adopt this governance, and then they can apply it to their local regulations and local requirements of banks quite quickly.
Yeah.
So I don't think we'll have a 10-year wait as we have for some of the other metrics to go through for this one. So next year, end of next year maybe is a realistic time.
Yeah, we can't compare Basel III to this. Basel III is huge and it touches every part of the economy. This is really specific to our world in OTC derivatives. So, I guess we'll wait and see. And I'm going to assume that we'll probably do another podcast to talk about, when a final proposal comes out and what it's going to mean for Acadia, what's going to mean for our clients.
Yeah.
And of course, always how we can help. Stuart, anything else before we sign off? Anything else you want to say?
I guess it's just, reflecting on what Acadia's here for.
Yeah.
And, you can get lost in the details of what you do sometimes. Acadia was set up off the back of the financial crisis to reduce counterparty credit risk. In some ways, this is just a great space for us to be in. And we get to continue on that journey of saying, okay, we've dealt with this area, we've dealt with this area, this feels good. And this area actually turns out we haven't dealt with as well as we thought. Yeah. So how can we help solve this next area? And yeah, I think it's just a journey, and there's a journey I think Acadia has been extremely successful at. So yeah, exciting to be part of it again.
Yeah.
For the next round.
Yeah. I mean, this is our podcast, so we'll toot our own horns. That's what we do. We solve problems. Great. All right, Stuart. Well, thank you so much. Pleasure as always, and I'm sure we'll be back in this wonderful studio again.
Yeah.
So
thank you very much.
Yeah. Thank you all for joining in this episode of Ahead of the Curve. I hope you found it interesting. I know I did. If you want to find out more about this podcast and other podcasts, you can find us on acadia.inc or any of your other streaming services. Thank you so much for joining us, and we'll see you again soon. Thank you.